So does Liberation Day present the beginning of a new economic era? It certainly is beginning to feel like that. Globalization and its product moderation really meant that growth was very strong and inflation was quite low. Now you're coming into a phase where growth is beginning to moderate as a result of these protectionist policies, and inflation pressures are sustaining. It certainly does feel like the end of the great moderation and us moving into a phase where growth is weaker and inflation is higher. Many in the market are hoping that President Trump's administration has just front-loaded the bad news in terms of tariffs. Markets are pricing in peak de-escalation that might be too complacent. And we would, at UBS, be a little more cautious than that. The possibility of tariffs staying and, in fact, rising modestly from where we are is, in my mind, reasonably high. In our minds, the probability is well below 50% right now. We are looking at 0.8% growth in the US this year. So that is not recessionary, but still very weak growth. But such as it is, we're not looking for a recession, but we are looking for below trend growth this year and also in 2026, neither of which is priced. Ordinarily, the Fed would look at inflation, the Fed would look at growth, put those numbers in a model, and the model will tell them what to do. If you did that today, the model will tell you to hike rather than to cut. The Fed is going to ignore that because the Fed is going to look at this as a one-off increase in prices rather than a step change in inflation, and they will focus on weaker growth, and that's why I think the Fed is going to be cutting rates not immediately, but by September of this year. When one tries to juxtapose the negative impact of tariffs on the economy relative to the positive impact on the economy coming from the tax bill, also coming from potential deregulation, it really is the increase in tariffs that dominate for significant economic variables like GDP or inflation. Any help that you might get here and now from the growth boost will be compromised by higher long end, especially long end interest rates, 10-year interest rates, 30-year interest rates. US exceptionalism was really driven by very aggressive fiscal policy, aggressive migration that led to very aggressive consumer demand and growth. All of these factors are now waning. The tactical call is US underperforms Europe and emerging markets over the next 3 to 6 months. The structural call, however, is that within the context of lower returns, the US still outperforms.